Hello and welcome to Pro Trader Strategies Market Commentary for Friday, June the 2nd, Unenjoyment Friday. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having that out of the way, let's get this on. Mentioned that it was Unenjoyment Friday. That was a floor term that we used to use for Unemployment Friday, first Friday of every month. And today we got our non-farm payroll numbers. Non-farm payroll came in at 138,000 hires, expected to be 181,000 hires, so a lot less than expected there. Also, last month's 211,000, which looked like it was pretty good, got revised down to 174,000 hires. So much worse on that front, albeit the unemployment rate did downtick to 4.3%, expected to be 4.4%. That part of the number is a little bit wanky, but it always is. The headliners, discouraged workers, people falling off the unemployment line and are no longer collecting unemployment, are considered no longer unemployed. So that number can downtick despite the fact that there might be layoffs and not really a whole lot of robust hiring going on. The other thing we got was the average hourly earnings came in right in line at 0.2%, expected to be 0.2%, and last month's number revised down from 0.3% to 0.2%. So a bit of a pullback all in all on the unemployment front. Equities are overall rallying. Maybe they consider that good news that the Fed may not raise interest rates at the meeting here coming up, not next week, I believe it's the week after that. So the overall markets could be pushing higher. Anyway, on to the overall markets. We've got crude oil moving up. Actually, it's lower. Yesterday, we kind of got a bit of an acceleration to the downside towards the end of the day. And today, market blasted to the downside on that economic data as the broader markets started rallying. We've come back and looking like crude oil may have found a bit of a bottom here. Went down and tested that $47 a barrel area that I was talking about, and has been repelled away from that and got above that 50% Fibonacci retracement level. So looking like these crude oil bugs could be having their way with it to the upside, and I put on a trade because it looks like it's kind of bottoming out there. Anyway, on to gold. Gold's pushing higher by about $8. You know, the fact of the matter is gold and bonds are not buying into this whole economic picture. Bonds actually starting to look like they want to start taking out some of that possibility of a Fed rate hike. So bonds are pushing higher. I thought we'd could see a consistent move sideways and even down to the point of control, but as the broader markets are starting to look at this, we could be seeing a bit of some of that pricing or higher interest rates taken out. Dow Jones, historical high today, 21,225-ish, and the equities are, everybody's happy right now. Bonds up, gold's up, crude oil not so much, but crude oil looking like we found a bottom, and the broader equities up. And IWM, even, I don't have a chart on it, but IWM is really blasting to the upside today as well. But the NASDAQ up 52.5 points and very near the highs of the day as we speak. So we are just about, 1.5 off of the highs. And then the E-mini S&P is a half a tick off the highs. Yesterday it was pretty fun. We were making new highs on the E-mini S&Ps, as we were talking, we could be seeing that happen right now as well, only being a half a tick off of the highs. When I started this, we started making new highs. As you can see, we're just getting a slight bit of a pullback, about a point off of the highs right now with the E-mini S&Ps, but still creating an intraday historical high right now. Then on to broader markets. What I did, if you watch me on Twitter, I said, you know what, I want nothing to do with LOL, meaning LULU, as a little bit of a joke there. I had a little bit of banter going back and forth with Jeff Mackey, who used to be on CNBC Fast Money with LULU. But LULU still held up with its high implied volatility percent. So I decided to go down here and sell some puts in Lululemon. So I picked the July and sold the 47.5 puts because it's only inside of 50 days to expiration. So that's kind of in that wheelhouse of getting that theta decay. If we get this volatility to contract a little bit more, that should be looking pretty good. But they did beat on earnings. So Lulu has a tendency to jump. The reason why I didn't trade Lulu for the earnings actually was because it has a tendency to outpace the market maker move by double, and I wasn't able to get outside of that market maker move and really collect a credit worth that type of risk. So I didn't take a trade on there, but did decide to go in this morning when the implied volatility was still a little bit high. I think Lulu is going to hold up in at least this area, if not just hang out at the point of control right here where the most time and volume has been spent. So somewhere up here, maybe try and cover this gap to the upside. Don't know if it's going to do that in the next time frame that I have this trade on, but at the end of the day, it is bullish and the market could want to trend higher. So I sold those puts just to collect some premium. And then on to, and it also helps me add some long deltas to my portfolio is another reason. So with XOP is the oil and gas production. It is going to go usually lockstep with crude oil. As crude oil pushes higher, it looks like crude oil found a bottom. Today, we're seeing this same type of setup in XOP. So XOP has come down here. This is going to act as some major support. As you can see, several times it's tried to go down here in this little area and has rebounded from that. I believe it's going to do the same. So in XOP, I did a similar situation where I sold the July 30 puts in there and collected 57 cents. So the July 30 puts are below this historic or 52-week low, I should say, and I think we're going to have some support to go higher on that, giving myself again more long deltas as the overall markets are kind of celebrating today on Unenjoyment Friday. That's all I got for you guys today with the daily market commentary. But today we are going to be looking at several stocks that aren't participating in this rally, and we can still take advantage, add some negative deltas to our portfolios just to kind of hedge some of that risk. We can be looking at like IBM, GE, who are really looking pretty weak right now. So, and I'll go into all of that in the webinar and set up a way to put a risk reversal into your portfolio and take advantage of any down move in the underlying and limit some of our risk if it happens to move to the upside. All right, so go to protraderstrategies.com and sign up for that. If you can't take that, take it easy.